Now, before we kick off segment 2, we'd like to remind you, please like, share, subscribe. Sharing this is helping us get new subscribers, and obviously your comments are always appreciated to have that back and forth and see what other people are seeing in the market as well. Here is just, we like to kick this off as kind of giving a brief summary of the four, things that really kind of drive where the economy looks, what is activity looking like, and that's why we're looking at gasoline, jet, disty, and residual. And here you can see that, the current is about 12.85 million barrels a day versus where we started at 11.5. So you can see that on an average level, we're still beneath that 13, but we had that little increase. That's the thinner line right there. And typically in January and February, we're at the lowest period of demand, as you can see, as we go back through 17, 18, 19, and then that typically increases as we get into March. But we're just starting from such a lower level. I mean, that's just, I think, the biggest thing to take away from this chart overall, which again is putting more refined product into storage. Even though we have refiners operating at such reduced levels, we're still not seeing that demand pull, which is leaving more crude leaving more refined products in storage overall, which again is going to be the kind of that weight that we continue to see as we try to get to some sort of normalcy through 2021. Distillate had a build of about 4.8 million barrels. You can see, obviously, we're moving in that wrong direction as we start to push higher. It's important to appreciate, though, that seasonally speaking, this normally happens at this point in time, and then we start to kind of see that draw down into January and into essentially the beginning of April. And I think it's important to look at that essentially 29-year average. As Jan kind of starts at the high, and then we pretty much bottom out, mid-April. The issue right now that we continue to see is obviously demand. Demand is the problem, but also imports. So as we said in segment 1, we continue to see imports coming from Europe. And they're not at the levels they were in December, but they're still elevated on the diesel and distillate side. So this right here in the pad 1, we continue to see elevated imports as we have a super tanker unloading in Florida, which is going to remain. Again, this is going to be timing delay. The imports will come back down, but they still will remain elevated versus where they normally are in during really historics, as all of this product competes to find a home, as we have less and less essentially demand just in the market in general. When we look at stock builds, it was pretty much every area recorded something fairly big. The 1, 2, and 3 had over 1 million barrels of product in storage. And the question is going to be, if we do get a polar vortex, if this cold remains, will that start to normalize a bit more in pad 1? Unfortunately, with the imports, that's going to offset. We still have exports which remain very low. So if pad 3 can't push it into the international market, they'll try to push it north, and that will keep the Colonial Pipeline fairly filled. And again, these are things that are going to weigh on just how much of that storage can we really draw down to get some of this normalization. When we look at demand, as we said that we thought we were going to see a big bounce, it was going to come something what we thought was going to be closer to the average. Here you can see that we're right back to the average point in time. Again, there's really not much to say overall. We think it's going to continue to be within the average, and there's the headwinds will remain how much demand is going to be out there given LNG, natural gas and propane market share that's taken from heating oil, while we do have more diesel demand. The question is going to be on the longer term of, as we start to see some tailing of weather, how much are we going to be able to draw down? And again, this is something where we continue to be kind of right within that normal move, which is why we think we'll see, that step back. But again, the drop down won't be that large in terms of demand, just because we do have some of those underlying bids, which this is one of them. I mean, here we have market demand sitting there for trucking at about 133. We were saying that we shifted ourselves higher to 105, 115. especially, and then in the econ show, we'll go through just how, small businesses are really concerned about inventory. Inventory remains an issue. Supply delays continue to expand, which has driven up the PMI, which you're going to have to rectify that somehow, and it's still coming from trucks. So this is where we continue to see the elevation. When we're thinking about 105 to 115, we're trying to think about the average over the longer term. So that's where we think the average will start to get to. But just given what we're seeing on the wholesale side, the inventory side, we're going to remain above that 120 for the next week or two as we try to get some of this product into the market. And it's really coming into the case in load availability, truck availability. We're starting to see some of that come due, and we're starting to see some of the adjustments as some of the rates have normalized a bit with refrigeration, flatbed, specialized starting to kind of come down. And as it comes down, we'll start to see some of those movements. Again, this is going to be one of those tailwinds that we keep talking about for diesel demand. Now on the rail side, we're in a new year. So now we're starting to see some of the comparisons. Total carloads remain down about 1.6%, but again, there's some efficiency gains behind that, so that's less of a problem. The one that we've seen a bigger increase in, and it's going to remain that case, is grains. And we'll talk about grains in the econ show. WASDE came out yesterday, and essentially we had pricing just go parabolic on the grain side, just as we continue to see a whittle down of total storage. Exports remain elevated. So again, hopper cars will remain strong. That will put an additional move in terms of farm products, grain, and food, as we do have food moving through the system, but we also have farm products. In the farm products, we have potash, nitrogen, all of these important. Just when we're thinking about it, we have to consider seed, we have to consider fertilizers. These are things that are going to continue to be moved through the system, as we're going to have a fairly strong planting season, just given where prices are. The motor vehicle side, we're seeing some delays overall, just because we're running short on some tech, especially chips and some other key components for the computer side. So one of the things that we're going to see some problems is going to be motor vehicle and some of those minerals. Petroleum products, again, that's a demand thing. Demand's going to remain problematic. So because demand's going to remain problematic, that's going to weigh on just total activity in the petroleum and petroleum product side. The intermodal, again, coming full circle back to storage, back to the wholesale inventory. That's going to keep intermodal well stocked, which is going to keep total traffic. Right now we're up about 4.7%. Just given grain, intermodal, again, those are things that are going to put some support behind it, and we'll see total traffic remaining elevated. So when we get into gasoline, again, gasoline remains one of my biggest concerns overall, especially just given where the demand cycle sits. We had a build of about 4.4 million barrels. Again, it was pretty much across the board, with the biggest being in PADD 2, the Midwest, and PADD 5, the West Coast. And anyone who's been following COVID, which is everyone, has been shouldn't be surprised based on the issues that we continue to see in California, other parts of the West Coast. The Midwest is getting a little bit better. So in terms of where some of these cases are coming down, imports remain flattish. And again, this is something where we'll see a little bit of an increase as we have some of those deliveries start coming through from Russia into the U.S., from Europe into the U.S., but it's still below where we were in December. So again, these are things that are going to weigh in general. When we turn to storage, you can see that we're essentially following the same trend. There's not too much to say one way or the other. The trend is going to continue. The more important thing is going to be the slope. You can see that we're seeing some steepness versus the average, and versus that top of the cloud. This is going to be a problem, especially as we see demand, as we have a lot of concerns on demand, that we think that the slope is going to remain elevated, and we're going to see continued builds overall, which is going to outpace kind of the average, because we normally see builds that start to dissipate, call it, the beginning of March. Instead, we think that we're going to push towards the higher end of this level, especially as we have problems in the export market, where they're still fairly, stronger than disti, but again, there's still some problems as we look at just holistically where a product remains. So we have domestic problems, international problems, refiners trying to increase some of their distillate cut, diesel in general. And now, mind you, when you make diesel, you inherently make gasoline, and it's important to appreciate how they kind of balance that side. So this is why we think gasoline is going to continue to increase in storage and outpace. And here is just an idea of where demand is, and we're looking this back through back to 2006 to compare it with some of the other economic slowdowns, especially obviously the financial recession, and you can see that we're still tracking well below average. We're setting new all-time seasonally adjusted lows. Right now we're at about 7.5, and as we keep saying that we think that we're going to be able to push something closer to about 7.7 million barrels a day of demand. So we still see some upside. But again, the pace is going to be fairly slow. The slope is not going to be there, which again is going to put more gasoline into storage, which will weigh on cracks overall, and then inherently oil demand. And the reason why, we say this is because we're looking at that 7-week average as we look at, okay, well, how quickly are we getting back to pre-holiday norms? And you can see on the grocery pharmacy side, we're still well below that spike as we, before we went into Thanksgiving, and then as we saw that December low. Parks, something similar, just again, that's weather. The bigger thing is retail and recreation. You can see we're still well off of those norms that we had pre-holiday Thanksgiving, and then they remain low. And it's important, again, to remember January is typically a slow month, but we're still below where we were, obviously, pre-COVID, but also pre-Thanksgiving as people do less, trying to stabilize. And we're starting to see some increases in cases, specifically in Europe, now in the U.S. And right now, if you think about, okay, well, January 13th, we're about 2 weeks away from where Christmas was. Now we're starting to see some increases due to people who saw family and friends through the Christmas and New Year's season. So this is going to keep people kind of capped and concerned and keep some of that avoidance. I know, just again, personal, this is anecdotal, but my kids, they have to do their dance on Zoom instead of going to the studio because some people in the studio are infected. So now that is a 2 week. So again, that's something little that just, my wife isn't going to take the kids to dance and home. And again, little things like that start to add up because obviously how many people are in that dance class, in that studio, that's less driving. And you can see how that can kind of compound as we look out, and everyone has their own instance of something similar in terms of that reduction. But on the other side, and this kind of gives credence to why we think there's going to be that support for just activity. This is looking at global transportation search. So who's searching for stuff? Who wants to move things? And that's why when we look at cargo, freight, maritime, rail, that is seeing some support as we come out of January, as we project into February. People need to move. And again, that's going to come back to small businesses. The logistical side, as they're searching for ways to get cargo, freight, maritime, and rail. The bigger problem is obviously that urban side where there's just urban transport that continues to fall. That's weighing. And again, that urban transport, as people move out of cities, less activity in cities in general. So we are seeing some shifts, but again, that's good in terms of supporting some of that diesel when we're looking at truck and rail in general. So, but when we look at the traffic side, so this is obviously Jan 1, so you're picking up some of the noise from people just doing less on New Year's Eve. But you can see how there's a lot of that from December 25th to Jan 1, people just did less. And now, just based on what we're seeing, and we'll have some more recent data, but you can see how a lot of this has really persisted. Again, not at 61 in Japan, for an example, but again, still a lot of pressure overall, as instead of getting back to where we were of down 3, they're now down about 20, just especially with the issues that we're seeing from the increase in cases. U.S., something similar, we remain closer to about that down 40.
And just thinking about, Gas Buddy. So according to Pay with Gas Buddy data, gasoline demand this past Monday was down 1.5% from last Monday. So for the first 11 days of January, gasoline demand is running down 2.3%. But for the December, first 11 days of December, thinking about how quickly can we get back to that pre-holiday increase, and right now we're trending down and below where we were in the first week of December. We're now down about 2.3% for the first week of January. Again, these are things that are going to weigh on just total demand. But when we look at according to Pay with Gas Buddy data, gasoline demand for the week ending January 9th, it rose just 1.16%. So again, that's an inherent problem, because even though the gasoline demand moves in terms of, it's a calculated number. So you go from storage to the rack and then to the pump, but we're just not seeing people pull from the pump. And then European road fuel demand has fallen on average by 27% in January thus far compared to pre-virus levels. Again, January is continuing to pull down. UK is down about 42%. We have Italy that continues to fall, with Italy having actually the biggest fall overall. And again, these are things that are just weighing on just general activity. Now, Descartes had an increase in demand of 3.3%. So we're starting to see some bifurcation in terms of where is that demand going to come from. So when we take Gas Buddy, Descartes, what are they seeing? That's why we think that we will get some increase in demand, but it's still going to be well off of where we were in December and where we normally are in January. Instead of getting back to about 8.1 on the low end, it'll get closer to about 7.7, 7.8. So getting some back, but again, not a real big amount, especially when we look at, obviously, Apple data. So we see a big drop overall. The U.S. is back below the baseline, down 4%, Germany down 27%, Italy down 33%, UK down 35%. Again, all of this is just moving in the wrong direction as we have an extension of lockdowns, as we have new cases coming on. Now in Ohio, they're saying that we found 2 new variants of COVID, which, again, the question is, well, how many variants are there now? And people are now concerned about ones that were found in Brazil, obviously the one that we know about in the UK. These are things that are going to weigh on people's minds as they consider how quickly can I get back to normal. Now, when we look at the regional aggregate, you can see the inherent move down. China is currently sitting with an increase in cases, which again is going to cause much bigger issues as we continue to go through the remainder of January, which obviously is pulling again all of this down in general, and we're just not seeing that recovery. Now, this is looking at nationwide, so we're looking at the U.S. Daily tests, not surprising. We had the dip for holiday. Now we're back above those highs, which is increasing the amount of daily cases. As you can see, that we continue to trend higher. January still below. January 12th was still below the average. So we're starting to see some of these cases, flatline. Right now, you can see on the currently hospitalized, that's starting to kind of roll over a bit, which we want to see some of these normalize overall. The concern now is that we're starting to see a little bit of an increase now that people are starting to come back positive based on the COVID, the Christmas spike, if you will. So the holiday effect in general. Daily deaths, unfortunately, continue to trend higher. Now January 12th, we're at 4,000, which is well above the 7-day average. Again, pulling that average up. Then just looking at added congestion. So New York City, Los Angeles, London, again, they're all moving in the wrong direction. And that's looking at into January 4th, just as people do less even after the holiday. This is looking at COVID net change in cases. India continues to trend in the right direction. That's going to be one to watch, and we'll look at Indian data in the Econ show. Worldwide, there's not much change to the better. It's kind of holding flat. Europe remains elevated. South Korea had their spike, Japan had their spike, quick lockdowns, quick reinstitution of some restrictions that started to normalize cases and bring them down overall, which is a positive. But their restrictions and their lockdowns continue to remain in place in order to avoid some of the bigger problems as we've seen spreads overall in general. And so Johnson & Johnson is out now saying that their vaccine is on track for a March rollout. The question is going to be, what is that aiming for? Because that's going to be important as we look at vaccinations. So here you can see daily new COVID-19 vaccination doses per 100 people. We're going to cover this in more detail in the segment 1 of the economy show, because there's a lot of nuances to what does this mean? How is this going to continue to flow? So U.S. has flatlined a bit. We will get an increase as some of these vials get pushed from storage, making sure that we can have enough for the second dosage, and people, they're just a rush to try to give everybody the first dose, whether that's right or wrong, we can debate. But again, this is something where we're going to start to see this trend higher as more people get those initial doses. Overall though, jet had a big spike, but this is really just recovering some of that demand that we saw from Christmas, Hanukkah, other holidays, and then obviously wrapping up with the new year. So jet had a draw of about 1.5 million barrels. Demand had a big spike. We're still below that 5-year average, but again, that's a big spike. That's going to come off hard this week into next week, and really through the remainder of not only just January but into February. And we're gonna see a new low, and we're gonna kind of bounce right around, call it the 1,000 barrel a day. The 1 million barrel a day mark, just because we just don't have the supportive demand overall. And the reason why we say that is when we look at just flight departures, you can see 480 coming out of the U.S., some U.S. hubs, other U.S. hubs down 440. We have China seeing a big drop. And again, this is going to impact what's happening in China. We have 2 outbreaks as we head into Lunar New Year. Those outbreaks are going to limit the amount people travel. We're seeing a lot of flights getting canceled. That is going, and that's happening in other parts of Asia. Again, some 2,500 fewer departures on average each day, week over week, and we know that last week was also slow. This is going to impact. This is why we're saying that jet fuel demand is just going to have that hard drop. Now that we have some of that, some of the jet fuel that was pulled through, that gets refilled. So right now, around 1,000 flights on average per day in February have been removed from the flight schedule since last week. February was down 2,900 flights. So yeah, that's another 1,000 on top of that. And again, this is just weighing on just that total issue. And now in the U.S., we're actually instituting new restrictions on international flights. Before we were kind of lenient on terms of what the requirements are. As that ratchets up, again, less movements. As we continue to say 550 to 850, we're right here at about 700,000. Then again, it's just going to tighten up, and we're going to stay within this fairly tight band, and we'll most likely start to roll over a bit. But again, we're going to sit within this kind of normalcy of, let's call it 1 million 2 off of normal from 2021, from 2020 and now into 2021. Then when we look at open table, as we've been saying, we're going to continue to trend to the downside. We're now sitting there with about 67%, 68% off of normal. That's going to be a big problem as we look at what are restaurants going to do, how are people going to adjust. And these are what those restrictions that we keep talking about. And when we look at the breakdown, across the board, global, we're at that 67%. So as we talk about in the weekends, we think that we're going to average about 55 to 58% down versus normal. During the week, we think that we're going to be between that 63 and 70% downside. And it's really being driven Germany, Ireland, UK. Those really tough lockdowns are going to keep most, again, just near 100%. Canada, parts of Ontario and other parts of Canada have gone into full lockdown, where you can get, I think it's $1,000 fine just for being or just seeing someone as their system gets stressed to the breaking point, again, post-holiday spreads. So Canada is going to be the biggest issue. Australia obviously remains the beneficiary, Mexico and the U.S. U.S., again, it's going to be that 65 average, 63, 65 average, which is going to weigh down some of this activity. Again, these are things that on why we continue to be concerned about the economy, about the fact that the market is pricing into perfection, essentially just this normalization that we continue to see cracks in overall as we head into not only just January, but the end of all of Q1 and as we project into Q2. And now, as this is just looking at the U.S., but when we take this and look abroad, we continue to see those additional problems in the broader market, which we'll talk about in the next segment.